the House and Senate lawmakers negotiating the final details of a massive bank regulatory overhaul bill agreed to a compromise on capital levels for smaller banks, while they advanced a series of proposals that would impose additional fees on big banks. The leaders of the conference committee on the bill hope to wrap up work on Thursday. Big issues are still unresolved, including whether taxpayer-insured banks should be able to trade derivatives and whether they should be able to trade on their own account. In the morning session, lawmakers from the House agreed with a Senate proposal that would allow smaller banks to continue to count existing trust-preferred securities, a form of hybrid debt capital, toward their capital standards. Larger banks would have 5 years to phase out this kind of capital, potentially forcing them to raise more capital from common equity. Chris Cole, a vice president at the Independent Community Bankers Association in Washington, said it would have been very difficult for small banks to raise common equity within the current constrained capital markets. He added that banks with less than $1 billion in assets would have had the most difficult time. Meanwhile, a proposal that would force big banks to pay hundreds of billions of dollars to wind down Fannie and Freddie is likely to be defeated, a banking analyst told MarketWatch. Late Tuesday, under prodding from Republicans, members from the House proposed that mortgage giants Fannie Mae and Freddie Mac be eventually liquidated through the Federal Deposit Insurance Corp.'s receivership system. That could mean losses of up to $200 billion that would ultimately be recouped from banks with more than $50 billion in assets. A fair share of the costs, however, House Financial Services Committee Chairman Barney Frank, a Connecticut Democrat, sought to clarify the proposal, arguing that big banks should not be responsible for the total cost of losses. Many of us believe that people in the financial community should have to contribute to some of the costs, Frank said. I do not think it is reasonable for them big banks to pay the entire costs of Fannie Mae and Freddie Mac, and I don't think anyone else does either. Democratic Representative Melvin Watt of North Carolina said the Democratic staff is working to refine the proposal. He said taxpayers shouldn't have to shoulder the entire cost of liquidating Fannie and Freddie, but neither should the large banks. However, Jared Seaberg, an analyst at Concept Capital in Washington, said he believes the Senate will reject this proposal, which will produce a sigh of relief from big banks with more than $50 billion in assets. A congressional staffer for Frank added that big banks could only be charged fees to cover the costs of Fannie and Freddie if bank regulators, including 2/3 of the Federal Deposit Insurance Corporation, and in consultation with the President decided they should be covered. She added that she expects the Senate to reject the controversial provision. Big banks could be hit with new fees, but they can celebrate that they won't be hit with much larger assessments originally considered by the House. The Senate and House agreed to drop plans to create the $150 billion fund that would have been created with fees charged on big banks. The fund would have been used to dismantle the failing mega bank so its collapse didn't unsettle the markets. Instead, lawmakers agreed to use taxpayer funds to dismantle the failing big bank and then seek to recoup the costs from big banks and hedge funds afterwards. Negotiators are working furiously, seeking to complete work on reconciling the two bills by the end of the week, in part, so the Obama administration can bring a completed bank reform bill to a G20 summit in Toronto over the weekend. The reconciled bill would next need to be approved by both the House and Senate, with a vote scheduled in the House for Tuesday. Congressional leaders expect the final bill to be approved by Congress and sent to President Obama for approval before July 4.